And joining us now to discuss is Rebecca Walser, president of Walser Wealth Management. Rebecca, welcome. Thanks so much for joining us. Big earnings this week from General Motors to tech giants like Apple and Microsoft. So what are you expecting as we continue to see these companies report, and which ones are you watching?
Well, obviously, we were excited to see GM beat on earnings per share and obviously really come really close to sales numbers. And it really is a testament to these third quarter earnings. And I think that it speaks to, we're going to probably see a lot of positive news. Obviously, Chloe, these companies have already sort of taken into account and lowered expectations throughout their projections because of COVID and all the things that still happen with the China supply chain. But we're excited that GM has beat, and we're expecting more of the same from today's announcements as well.
Now, Rebecca, of course, we've got big tech earnings coming out this week as well. We did hear from Snapchat last week. Disappointing. It fell about 28% on the back of that result. But experts have said it's not a bellwether for the entire tech industry. So what are you expecting to see from these companies? Is this going to be a turning point for the sector and the market?
It's a great question, and I think Snapchat was not a bellwether. Let's pray that it wasn't. But, tech is going to have troubles because we have relied on them. They have done so well for us, I'd say, since 2018, coming out of the back of the last quarter. And we've really ridden that ride. And so I think, we can expect too much from tech sometimes. And especially in a change year when the cost of capital is going up, these are very labor-intensive, capital-intensive projects to bring new things, always, bringing new software capabilities to their platforms. And so it is going to be a challenge for tech, and we shouldn't have too much expectation. I think that it's time for them to have a breather a little bit, and we really need other sectors to step up and carry the weight right now, especially in this global changing world that we have.
Good point, Rebecca. Now I want to talk about the Fed quickly. We have the president of both the Chicago and San Francisco Feds warning against raising interest too aggressively here. This has, of course, stoked some optimism that we might see a bit of a less hawkish approach from the Fed. What do you make of their statements? Do you think the Fed is going to pivot from its plan to raise interest rates?
Yeah, it is, it's alarming to me how much power this Fed has. And I think that's one of the biggest things that I've taken away from this whole, since coronavirus in 2020 is, wow, the Fed really is and can be a market setter. And that's why we have the saying, don't fight the Fed. But the Fed is not in a rock and a hard place here, because if they pivot, then we've got a whole nother slew of problems about the stability of the U.S. dollar as opposed to the strength of the U.S. dollar, which is why they've been so hawkish. So to see the Fed of both San Francisco and Chicago within literally days of each other say, hey, we really have to be careful not to over tighten and move too fast. And otherwise, the market liked that yesterday. I mean, the market was in love with those sentiments yesterday and getting a pivot. I mean, if you watch the CME watch, we're down to a 53% chance of a 75 basis points. That's the lowest we've had since they've started raising. So the market has a good chance that we might see a pivot. And I think the market likes that, although I don't know if that would be the best overall global policy change for us.
Now let's talk about the U.S. Treasury yields. They did edge higher on Monday, but they still closed well below their intraday peaks on Friday. Should investors be hopeful about this, that this more stable bond market could ease pressure on stocks too?
I mean, it depends on this Fed policy, right? I mean, I still don't like the inverted yield curve, and that obviously says that systematically there's a problem. If the government is paying less on the 10-year than they are on the 2-year, that tells investors a story that we're not sure about our future, but we're more sure about our short-term future, and that's never a good sign for markets. And when it's sustained like this, it's also problematic. But I think that the markets like cheap cost of capital. We've had literally since the great financial crisis in 2008, 2009, we've had really low cost of capital. We've had such expansionary corporate structures and offerings, and we've really done well with that. And we're kind of at the end of that, and we don't do well with tightening. We don't do well in the absence of stimulus. And so we have to systemically change how we're working, Chloe. We can't constantly rely on the Fed, and that is going to be a painful process. The question is it now or is it a little bit longer from now? When is it going to come? Because we do have to adjust and really go back to more market machinations rather than just the Fed interest rate policy and stimulus policy.
And Rebecca, while I have you, I want to ask about the auto sector. We had General Motors reporting adjusted net income of $4.3 billion, up from last year. But parts shortages continue to present challenges for the company and the entire auto sector. On the flip side, big ambitious EV plans. But let's talk about those woes here for a second. Are they expected to continue for the sector? And will those EV plans be enough to kind of uplift them here?
It's a catch-22, just like the Fed is in with GM, because they have to pivot their structure. They have to move. The world is moving to green technology, and they have to do the same. So we were really excited about these Q3 results. I think it is a bright and shining light for their future, and it lets us know that they can get through really difficult times. Capital structure, they have obviously the highest debt to capital in the industry, so we always care about the cost of capital for GM, and and they have to do a lot of so much retooling to get all of their factories up to the EV standard, but they have made massive strides, and I think Q3 is a really good example of the fact that they are still in the game. And let's wait and hope and find out if EV will eventually succeed for them. It's going to take some time, but I'm rooting for them. We need an American EV company besides just Tesla running the show.
Rebecca Walser, president of Walser Wealth Management, thank you so much for your time this morning, Rebecca.